Hi, my name is Hank, your host at Global Finance Mindset. What you are about to hear is not a theory. It is not a rumor. It is not the paranoid fantasy of someone who lost money in a bear market and needs someone to blame. What you are about to hear is a documented, verified, and deeply unsettling account of how the most powerful financial machine in human history quietly extended its reach into the one asset that was never supposed to be within its grasp. This is a story about Bitcoin. But more than that, it is a story about power, about algorithms operating in the dark, about lawsuits filed in federal court, about a trading firm so secretive that most people on Wall Street itself have only whispered its name, about regulatory bans spanning 3 continents, and about a single haunting question that sits at the center of all of it. If the system was rigged from the beginning, was Bitcoin ever truly free of it? Settle in. Keep your eyes open. And by the time this ends, I promise you will never look at your Bitcoin portfolio or the financial system behind it quite the same way again. Prologue. The asset that was never supposed to exist. October 31st, 2008. The world was on fire. Lehman Brothers had just imploded. The global banking system was hemorrhaging trillions. Governments were frantically printing money to paper over the wreckage, and ordinary people were watching their savings evaporate, while the institutions that caused the crisis received bailouts measured in the hundreds of billions. On that Halloween night, an anonymous figure calling themselves Satoshi Nakamoto published 9 pages that would eventually reshape the concept of money itself. No central bank, no intermediary, no permission required, no hidden leverage, just mathematics, immutable, verifiable, incorruptible. Bitcoin was born from betrayal. It was engineered as an escape hatch from precisely the kind of system that had just detonated. For years it lived in the shadows. Cypherpunks, libertarians, programmers storing private keys on forgotten hard drives. The established financial world laughed. Economists called it a bubble. Regulators called it dangerous. Bankers called it nothing. Then something changed. The asset grew too large to ignore. The price climbed. Institutional interest stirred. And slowly, inexorably, Wall Street began to move. Because Wall Street does not fight revolutions. It absorbs them. Chapter 1. The firm nobody talks about. There is a company that makes more money from trading than Goldman Sachs. More than JP Morgan's entire trading desk. More than Bank of America. More than Citigroup. In 2024 alone, this firm generated $20.5 billion in net trading revenue. A number so staggering, it would make the chief executives of most major banks go pale with envy. You have almost certainly never heard of it. Its name is Jane Street. Founded in 1999 in Manhattan, Jane Street employs roughly 3,000 people and pays each of them an average of $1.4 million per year. There is no flashy CEO appearing on magazine covers, no retail marketing campaigns, no public bravado, no press conferences, no shareholder letters. The firm is run by a management committee of 30 to 40 people, operating with the flat hierarchy of what one internal description memorably called an anarchist commune. They are, at their core, a quantitative trading firm. Not a hedge fund. That distinction matters more than it sounds. Hedge funds face disclosure requirements. Banks face disclosure requirements. Jane Street, structured as it is, does not, at least not in the same way. This is not an accident. It is architecture, deliberate, precise, invisible. What Jane Street does, in the simplest terms, is this. They sit in the plumbing of global financial markets. They estimate they are involved in roughly 10% of every stock trade made in the United States on any given day. Not investing, facilitating, not holding, arbitraging. Always in the middle, always unseen. Turning microscopic price differences into colossal rivers of profit through sheer velocity and mathematical precision. For a long time, that was enough. They were extraordinarily profitable and extraordinarily private, and those two things suited them perfectly. Then Bitcoin got its ETF, and Jane Street stepped into the spotlight it had spent decades carefully avoiding. Because Jane Street is one of only 4 companies in the world authorized to create and redeem shares of BlackRock's iShares Bitcoin Trust, the ticker IBIT, the largest spot Bitcoin ETF on the planet. They sit, as one analyst put it, in the plumbing. And whoever controls the plumbing controls the flow. Chapter 2. The Door Opens. January 2024. The U.S. Securities and Exchange Commission approved spot Bitcoin ETFs for the first time in American history. It was a watershed moment. For the first time, mainstream investors, pension funds, family offices, cautious retail buyers who would never touch a crypto wallet, could gain exposure to Bitcoin through a simple ticker symbol on a traditional brokerage account. The reaction was extraordinary. Billions poured in. IBIT alone attracted more assets in its first year than almost any ETF in the history of American finance. Bitcoin surged. The narrative was triumphant. Institutional adoption had arrived. But here is what that triumphant narrative glossed over. Behind every ETF lies a hidden mechanism most investors never think about. Someone must create new shares when demand exceeds supply. Someone must redeem shares when investors want out. Someone must make sure the ETF price stays close to the actual price of the underlying asset it represents. These entities are called authorized participants, APs, and they possess powers that no ordinary investor has. APs can create shares and sell them into the market before they've even sourced the underlying Bitcoin. They are exempt from standard short-selling restrictions that apply to every other market participant. They can sell shares they don't technically own yet, relying on their creation mechanism to cover the position later. This is legal. It is structural. And in the hands of a firm with Jane Street's sophistication and capital, it is extraordinarily powerful. But there is something even more important. When Jane Street files its quarterly 13F reports, the public disclosures showing what major institutions own, those filings reveal only one side of the ledger. They show the long positions, the shares held. They do not show the derivatives, the short positions, the options, the swaps, or any of the hedging activity that determines Jane Street's actual exposure to Bitcoin's price movement. So the public looks at a filing showing Jane Street held roughly $790 million worth of IBT shares in the fourth quarter of 2025. They see a bullish signal. Surely, a firm of that caliber buying nearly $1 billion of Bitcoin exposure must believe the price is going up? Perhaps. Or perhaps their net exposure is zero. Or negative. Perhaps they are holding the shares as inventory, not as a directional bet, but as a structural position hedged on the other side through instruments no one can see. Perhaps they are, simultaneously, one of the largest visible holders of Bitcoin exposure and one of the most aggressively positioned entities betting against it. We would never know. The system does not require them to tell us. Chapter 3. The Pattern. It began quietly. Around November 2025, traders started noticing something strange in Bitcoin's behavior. Something rhythmic. Something that felt, to those watching closely, almost mechanical. Every trading day, as the clock approached 10 a.m. Eastern Time, precisely the moment U.S. stock markets opened, Bitcoin would drop. Not catastrophically, just enough. 2%, sometimes 3%. A sharp, sudden move during one of the lowest liquidity windows of the trading day, when a relatively small volume of selling could move the price of the world's largest cryptocurrency by a meaningful margin. For leveraged traders, the hundreds of thousands of retail investors who had borrowed money to amplify their Bitcoin positions, that 2 or 3% was not a minor inconvenience. It was a liquidation event. Automated systems, pre-programmed to close positions the moment collateral fell below a threshold, triggered immediately. Selling cascaded. The price fell further. More liquidations triggered. More selling. More price decline. A chain reaction that extracted billions from leveraged positions in minutes. And then, often, Bitcoin would recover. Patterns emerged on social media. Analysts began documenting the drops on charts, overlaying them day after day, week after week. A viral thread on X showed the phenomenon occurring dozens of consecutive times with eerie consistency. Yann Happel and Yann Allemann, co-founders of blockchain analytics firm Glassnode, publicly noted the pattern. Bitcoin researchers pointed out that these drops were clustering in low liquidity windows, precisely when a relatively small amount of capital could create disproportionate market impact. The theory that emerged, whispered at first, then shouted, was elegant in its simplicity. What if a sophisticated actor were buying spot Bitcoin, then simultaneously opening large short positions in derivatives markets, then triggering the price drop through concentrated selling at the precise moment it would cause maximum pain to leveraged longs? You lose a little on the spot sale, you gain enormously on the short. You close the short, you buy the spot Bitcoin back cheaper. You repeat. It is, in structure, not dissimilar to strategies that have been documented in other markets. It does not require conspiracy. It requires capital, mathematical precision, and a position in the market infrastructure that most participants do not possess. And then the lawsuit dropped. And the 10 a.m. pattern, that clockwork, daily, relentless drop, stopped. Bitcoin surged nearly 10% in 48 hours. $200 billion was added to the total crypto market. Short liquidations hit $213 million in a single day as shorts were squeezed. BlackRock's IBIT saw $250 million in inflows in one session, potentially ending 5 consecutive weeks of outflows. Correlation, of course, is not causation. Markets are complex. Coincidences occur. Not everyone accepts the pattern as evidence of deliberate manipulation. Some analysts, including economist Alex Kruger, argue the drops reflect normal repricing when U.S. markets open with fresh information, and that Bitcoin typically recovers to its pre-open level within 30 minutes. But the timing was very hard to ignore. Chapter 4. 3 continents, 1 fingerprint. Here is where the story becomes something more than speculation. In July 2025, months before the Terraform lawsuit, months before anyone was publicly connecting Jane Street to Bitcoin's price behavior, India's financial regulator, the Securities and Exchange Board of India, known as SEBI, issued a 105-page enforcement order. It was one of the most sweeping market manipulation findings in Indian regulatory history. SEBI accused 4 Jane Street entities of manipulating India's 2 most important stock indices, the Bank Nifty and the Nifty 50, across 18 derivatives expiry days between January 2023 and March 2025. The language SEBI used was, for a financial regulator, almost prosecutorial in its sharpness. It called Jane Street's conduct a deliberately devised scheme to manipulate settlement prices. It noted that Jane Street had continued executing this strategy even after the National Stock Exchange of India issued an explicit warning in February 2025. The strategy SEBI described was strikingly methodical. In the morning, what the regulator called Patch 1, Jane Street's entities would aggressively buy component stocks in the Bank Nifty index. On multiple days, their trades represented more than 20% of total market volume in individual securities like Kotak Bank, SBI, and Axis Bank. This relentless buying pushed the index higher. Simultaneously, Jane Street built large short positions in index options, selling calls, buying puts, positioning to profit when the index fell. Then, in the afternoon, Patch 2, they reversed completely. They sold the stocks they had spent the morning buying, driving the index down, directly into the expiry of the options they had sold against. The India regulator calculated total profits from this strategy at approximately $4.3 billion. SEBI froze $566 million of Jane Street assets and banned the firm from Indian markets entirely. The language of the order was unusually harsh. SEBI wrote that the fairness of the market and the trust of millions of small and medium investors and traders cannot continue to be held hostage by the machinations of such an untrustworthy participant. Jane Street disputed the findings and appealed. The case was pending before India's Securities Appellate Tribunal at the time of this recording. And then there is China, where several Jane Street accounts face allegations of manipulating silver prices through ETF positions. And then there is the Millennium Management lawsuit, in which Jane Street's Indian options strategy, the same one, was described in court as generating approximately $1 billion in a single year. 3 jurisdictions, multiple asset classes, the same structural pattern: acquire a privileged position in market infrastructure, use it to move prices, profit from the derivatives layered on top. This was not a coincidence. This was a playbook. Chapter 5. The Ghost of Terra Luna. To understand the Terraform lawsuit, the one that detonated this entire story, you must go back to May 2022. Back to one of the most spectacular and devastating collapses in the history of finance. Terra was a crypto ecosystem that, at its peak, was worth roughly $40 billion. At its heart were 2 tokens: Luna, a cryptocurrency, and UST, an algorithmic stablecoin pegged to the US dollar. The mechanism was elegant in theory. When UST dropped below its dollar peg, the algorithm would automatically create new Luna tokens and use them to buy UST, restoring the price. As long as confidence in the system held, the peg held. The collapse began on May 7, 2022. Someone, a wallet the lawsuit would later allege was linked to Jane Street, withdrew $85 million worth of UST from a major decentralized liquidity pool called Curve. This was not a random moment. Just 10 minutes before that withdrawal, Terraform Labs itself had quietly drained $150 million from the same pool, with no public announcement. The sequential nature of those 2 withdrawals, the lawsuit alleges, was not coincidence. The $85 million withdrawal overwhelmed the system. UST began losing its peg, from $1 to 99 cents to 98 to 95. The algorithm responded as designed, creating new Luna tokens to buy the depreciating UST. But more Luna in circulation meant Luna's price fell, which meant UST's backing weakened, which meant UST fell further, which triggered more Luna creation, which crashed Luna more. A death spiral, self-reinforcing, unstoppable, consuming itself. In roughly 72 hours, Luna went from $80 per token to essentially zero. UST went from $1 to zero. $40 billion in value was destroyed. People lost their life savings, their retirement funds, their children's college money. Gone over a long weekend. The collapse triggered a chain reaction that took down Celsius Network, then Three Arrows Capital, and eventually provided the conditions that led to the implosion of FTX and Sam Bankman-Fried's empire. The total damage, direct and indirect, ran into the hundreds of billions. The Terraform lawsuit, filed by bankruptcy administrator Todd Snyder in Manhattan Federal Court, alleges that Jane Street was positioned ahead of all of this because a former Terraform Labs intern, someone who had intimate knowledge of how the system worked, had left Terraform and gone to work at Jane Street. This individual, the suit alleges, was part of a private group chat where former Terraform insiders shared non-public information about the project's vulnerabilities. Jane Street, the suit claims, used that information to construct a trading strategy built around the certainty of collapse. The lawsuit's language is stark. The trades Jane Street executed could not have occurred absent access to its exclusive possession of material non-public information. Jane Street called the lawsuit a desperate last-ditch effort and baseless allegations. The legal process will determine the truth. Courts exist for precisely this reason. But there is one more detail attached to this story that belongs in any honest account. One of Jane Street's co-founders, a figure named in the lawsuit, separately wired $7 million that was used, according to a verified U.S. Department of Justice investigation, to purchase AK-47s, Stinger missiles, and grenades for a coup attempt in South Sudan. This is not allegation. This is documented federal fact. And Sam Bankman-Fried, the man who presided over the collapse of FTX, one of the most brazen frauds in crypto history, was a Jane Street employee before he built his empire. So were several of his future FTX colleagues. At some point, coincidence demands a second look. To be continued. See you tomorrow for part 2. I hope you liked this video. Please share your comments down below, and if you found this video helpful, share it with someone who is important to you so they can benefit from this information too. And if this helped you, hit like and subscribe so I know I should keep bringing you more content like this.